Hey everyone, and welcome to the show. Today, I'm very excited to announce our guest for the day, Jeff Greenberg. Jeff, thanks so much for being here.
Well, thank you for having me. This is exciting.
Yeah, definitely. Well, I'm excited to share your story with the audience and see where the conversation goes. So, Jeff, everyone, is a multifamily investor and he has been investing in multifamily for over a decade now. So, Jeff, why don't you take us back in time and tell us why you got interested in real estate and what drew you into the space?
Well, I was actually on a hike with a friend who told me that he was going to get into real estate. And at that time, this was about 2005, I believe. At that time, the only thing I knew about real estate was, oh, you go buy a house, maybe you fix it up, you rent it out, and that was it. I didn't really know anything about fix and flips. I just knew buy and hold. Oh, okay, I'm going to be a landlord. And then when we looked further, we started looking at REOs, bank-owned properties, and that wasn't working very well, mainly because prices were starting to drop out here in my area and the area we were looking at. Prices were dropping, and so they were dropping so fast that the banks didn't know what to do with all the foreclosures they were getting. And then I bumped into somebody that was talking about commercial real estate, multifamily, and that I could leverage other people's money and not just rely on my own to get into deals. And so I started to pursue that area.
Okay, interesting. So and may I ask, what was your career before you were looking at real estate? And were you looking for like a side hustle or just what was it that intrigued you about it?
Well, it was mainly something to get me out of my day job.
Mhm.
Now, I was also going through a divorce. So I saw my primary residence disappear. I still had my retirement. And so I was going to be able to use some of my retirement money to invest, but that wasn't going to last me. And so that was, definitely the motivation. I was in IT. I
Mhm.
worked for a technology company and I wanted to retire from that. I was tired of it. And in technology, you're always learning new things. There's always new stuff coming out. And I decided it wasn't something I really wanted to, stay in for the rest of my career. I wanted to find a way out.
Yeah, for sure. It makes a lot of sense. I mean, I think real estate offers a lot of flexibility to people who want to, need to make a change in their life for one reason or another. And a lot of people face burnout, in this day and age. I certainly did. And so, okay, so you got involved at a very interesting time, and I know you have some interesting stories we were talking about before the show. So, you got started to get into real estate basically as the bottom was falling out. So can you tell us what that was like and where you first started looking?
Well, first started looking locally, single family homes. I
You're
figured
in
I was going.
SoCal, right?
I'm in Southern California, and I was going to do some fix and flips. And well, actually, they were REOs, so they're already bank owned because there was a lot of bank owned properties at that time. But the bank was taking so long to get back to us and accept our offer. And then when I asked for a repair allowance, they took another like 3 months or so. And the values that, the value of the property were dropping so fast in the area I was looking. And so my profit just was disappearing. So I couldn't deal with it. The banks didn't know what to do all the properties that they had that they
Mhm.
were foreclosing on. And so a lot of them even stopped foreclosing because they didn't know what to do with these properties.
Mhm.
So they didn't know. And so they were too slow.
That's
And
such an interesting thing to start buying real estate at a time when the values are going down, right? Like that, it seem, I don't hear that very often because oftentimes there's like a crash in values, but you were just seeing a steady decline. Is that right?
yeah, some of the areas like up in Oxnard, I'm up here in Ventura County in California. And eventually a lot of those properties lost 50% of their value.
Mhm.
They
Mhm. Of
did, I mean, but now everything, it's recovered now.
course. Yeah.
But back then the values dropped dramatically. And yeah, they were dropping down. I was trying to find some properties and to flip them real quick, but the prices were dropping too fast.
For sure. And in your perspective, was that because we were overbuilt in SoCal at the time?
No, that was it. It wasn't. I don't think we're ever overbuilt in Southern California. Southern California, there's always tons of housing, plenty of homeless. Um, the reason it was dropping is a lot of people had a lot of these bad loans that they
Mhm.
couldn't afford. As we were talking about earlier, a lot of people got into variable loans. They got into liar loans where they could say anything they wanted to. And then when the loans were coming due and the people no longer qualified, mainly because either the value had gone down or they stopped allowing the liar loans, all of a sudden people had properties that were upside down. The
Mhm.
loan was higher than the value of the property, and people were, well, I'm just going to walk away.
Mhm.
So there was people that would just walk away from their properties because they weren't going to get, they couldn't pay off the loan.
Mhm. Yeah,
They'd give the keys back to the bank and say, here's the keys, you got it. you know
for sure. Yeah. So, okay, tell me about some of the other things that were going on at that time, like other people who were trying to get into real estate, and what was the mentality back then? Trying to get at like what was causing people to sort of go under once things really fell out.
well, I mean, there were other people that were trying to do short sales, that were trying to help people that were upside down to get out of their loans. And a good friend of mine he went through some training on how to do short sales, but that really bothered me. I didn't want to be having to deal with people that were under duress.
Mhm.
And, I mean, the people were losing their houses.
Mhm.
It could have been a family house that they put a bad loan on and now it's coming due.
Mhm.
And I didn't want to do that. And that's why I was looking mainly at the bank owned property. So these properties were already foreclosed on. The bank already had them on their sheet, and I was trying to help them do that. But the bank just wasn't releasing them, and they just didn't know what to do with them. They didn't even have the staff to handle it. So they were just hanging on to them on their balance sheet. And, that's when I was starting to look at other things.
Okay, for sure. So where did you turn that next?
Well, I happened to bump into a guru that started talking about multifamily and talking about commercial real estate, and talked about how you can leverage other people's money. Okay, as I said, I was going through a divorce, so I had limited money. A lot of my money was tied up in my retirement, and even once I quit my job, I would have a limited amount of money that I could invest. And so the idea of being able to use other people's money and get into deals, that excited me.
Mhm.
I decided that was the direction I wanted to go.
Mhm. For sure. So did you do what was your first deal?
My first deal was actually a 20-unit property. It was in a town called Harlingen, Texas, which is near Brownsville.
Mhm.
If anybody knows where that is, it's where Brownsville is, where SpaceX has their launch site down there. But it was near there.
Mhm. Okay. And yeah, tell us about, I know the story of the first deal is the law of the first deal. It's an important hurdle for a lot of people. How did you find that deal and how did you put it together?
Well, I found the deal through a broker relationship. I found the broker by going on LoopNet and looked at a bunch of properties, talked to him about his properties. None of those really worked out, even though we did try to get some of those properties. But I established a relationship with this broker, and I went out. He lived in McAllen, Texas, which is right up against the border. and we became pretty good friends. In fact, I would stay at his house when I was out there, and I met him and his family and everybody. And eventually he finally brought me this 20 unit property.
Mhm.
And the thing is this was in 2010. The property was built in 2007. So it was an almost new property. It was 3 years old. The owners were the developers. They built them in 2007 and then couldn't get rid of them because the market had dropped. And so they were waiting until they could get the price that they wanted.
Mhm.
And then I came in and was able to give them that price.
Okay. Awesome. Yeah. And then were you working with like, did you have a group that was supporting you, like that you were, a lot of times it's hard to do it up by yourself. So just curious, like what your network was like back then.
Yeah, I had essentially one partner.
Hmm.
I had met her through some seminars and through some mentorship programs, and she's actually out of Alaska. And so we were working together, and we got together probably in 2008. And so for 2 years, we were looking for deals,
Hmm.
and it was a while. One of the things that we had been taught, which I laugh at now, and I laugh when I hear people talking about it, was we were looking for 8.5 caps with a 12% cash on cash return, with a debt coverage ratio of 1.6%. Well, you couldn't find those then. And I've heard people that are still talking about that same thing. And I'm saying,
Yeah.
are you kidding me? They're still
Right.
teaching that.
Hmm.
So there were deals that we passed up that we shouldn't have, that would have been great deals. And so it took us 2 years to find the deal that we did get. And it was a great deal. It was a great lesson. There was a lot of things we learned out of that deal.
Hmm.
So that was important. And what the deal, like I said, was only 3 years old. It was 100% occupied. And um, they were already paying their electric. So what the problem was is there wasn't a lot of upside. It was a great stabilized property, but there wasn't a lot of value add that we could put in there. Our
Right.
plan was to raise rents.
Hmm.
Our plan was also to build back for water. They were already paying for electricity. And so billing back for water was very difficult. We had a very difficult time and met with some great resistance that we just weren't able to rent the units if we were billing back the water. And
Hmm.
then we tried to raise the rents, and the rents weren't going up as fast as we wanted to. So increasing the value was a real issue. We couldn't increase the occupancy. We already had that. And so we the big mistake we made is there was really very little upside
Hmm.
to the property. Now, this is a pretty small, sleepy town, but they were just bringing in a Bass Pro Shop, which, if you're familiar with Bass Pro Shop, is Disneyland for most sports enthusiasts.
Okay.
And if you've ever been there. And
No,
so
I
they
haven't.
were just developing that Bass Pro Shop. They were just breaking ground. And we had high hopes that they were going to bring in a lot of business, a lot of new people, and we would be able to raise rents. Well, that part didn't happen. So it didn't bring in a lot of population.
Okay. I see. So it did open, but it didn't increase the population.
I mean, it didn't, we were hoping that all around it would be all kinds of businesses, and that was very slow. It was a very slow thing. And so we weren't able to raise the rents as we had hoped for.
Okay, for sure. Yeah, I mean, I think that's a good lesson to learn, right? Like there needs to be a yeah, like figuring out some kind of balance between reducing expenses. I mean, I assume those developers, like oftentimes when you build new, you're often going to be selling to someone who wants more of a stabilized asset. So that does make sense. What, how did that work out for your investors, and where did you go from there?
Well, the investors did okay. they did better than they would have if their money was in the bank.
Sure.
They didn't get the returns that we had hoped for. But the thing is we didn't make any money the entire time, except we did get an acquisition fee. So we got a little bit money up front. We made a tiny bit of profit at the end, and we got zero during a 6-year hold. So we got a lot of investors that were very pleased with us because we kept going, even though we weren't making any money. But it was just a long process for us. It was a learning process for sure, that we learned how to work with property management because we did have a manager. But
For sure.
it
Well, I
was a
mean,
great lesson.
yeah, totally. And I mean, the truth is that that's how we learn the best, is through actually taking action and making things happen. And, uh, we're going to learn along the way. That's just the nature of the beast. So, yeah, you've obviously come a long way since then. That was, 10 years ago. So tell us, what is it, what was your trajectory, from that first deal to where you are now? Just tell us a little bit about that.
Well, the next deal we did this, so this was just a 20 unit. Then the next deal we went with got a 60 unit, 62 unit. And this was in Houston, and this was a great deal. So we went from a newer property with not such a great deal to an older property that was a great deal, because this was 62 units, and we paid about $21,000 a door for it. At that time, Houston was going for about 25,000 to 35,000 a door. So we did get a great price on it. And it was 85% occupied. And so what we did is we increased the occupancy. We actually added 2 additional 2-bedroom units. We were able to convert 2 of our 1-bedrooms into a 2-bedroom. And so we increased the occupancy. We initiated a bill back, a RUBS, because it was all bills paid at the time. And we were able to raise rents. And also the cap rate was compressing at that time. So in 3 years, we were able to give our investors 120% return. So,
yeah, that's amazing.
40% annualized return.
Yep.
They were real thrilled with that. And, so that was, it was a good thing going from the first deal, which was a good lesson, to the second deal where the investors were very happy.
For sure. And did you have any repeat investors coming from your first deal to your second deal, or did you?
Yes.
Okay.
Yes, we did. We had a few.
And then how did that conversation go? How were you able to bring them back to the next deal?
Just brought them the next deal and showed them the numbers. And, they understood. They knew that was our first deal, that other one. And for the most part, with my partner, this was only a $350,000 raise, which was a pretty, small raise, but it was huge. It was huge for us at the time. She got it all from friends, not family, but friends and business associates. I got the investment from people that I had met at different real estate events, either seminars, boot camps, meetups, whatever. And so that's where I got that. And they knew it was our first deal. And a lot of them came in, on the second deal, and some moved from that one to the third deal. And there's a couple of them. There's some of them that are still with me 10 years later. 10, 11 years later, I have a few of those people that have just been jumping from one deal to the next.
Totally. Yeah, that's awesome. Well, thank you so much for sharing a bit about your background. Why don't you tell us what kind of deals you're working on these days before we wrap up?
Well, right now, I'm not looking so much for deals as I am looking for operators. I have made a shift, and this is something that was started before COVID. But basically, over the years, I've met lots of high quality deal sponsors or operators. And so I'm looking to partner up with different experienced deal operators that have a great track record. And what I will bring to the table is equity. And so it's two paths. One, I'm looking for some deal sponsors to work with, and I'm always looking for investors that are looking for high quality deals that I can bring them into. And one of the things that I've found in all my years is my investors, and most investors, don't do the due diligence and don't really do what they should do up front, the due diligence on the deal sponsor and enough on the deal, and actually read the full PPM and the operating agreement. And so I do that. And so I go and find investments for my investors, and they can come in with me and we'll go into those investments.
Yeah, totally. I think that makes a lot of sense to have someone who you trust, who's actually vetting the deals and the deal sponsors and the market and doing due diligence. Because, most people don't really have time to do that all on their own alongside everything else they've got going on in their lives. So it makes a lot
Either
of
the
sense.
time or the time and knowledge. I
Totally.
mean, there's been so many deals that I've had people look at and they've asked me for my opinion of it. And I've looked over the numbers, and, I would, advise them not to,
Yeah,
because some of the numbers, numbers are easy to manipulate. And
totally.
if you don't understand the business, it's difficult to understand it. And so I've seen plenty of deals that are not very conservative, that are maybe very aggressive numbers, that if all the stars aligned, then maybe they would be able to get somewhere close to that. But
Totally.
other than that, the chances are that maybe they're not going to get those returns.
Yeah, for sure. Yeah. I mean, it's so true. Like the numbers are very easy to manipulate. And so it's important to know how to look at those, or know someone, trust someone who knows how to look at them and make sure. And then the other part is the who, not the how, so like, who actually are you investing in, and actually building that relationship actually takes time, right? Like a great sponsor doesn't necessarily have the time or capacity to be building relationships with all of the investors that they need to be building relationships with to grow at the speed at which they want to and can grow. So
Absolutely.
yeah, it makes a lot of sense to kind of divvy it up and have some people who are more on the education relationship side, making relationships with investors, and then partnering up with people who have operate experience, specialties in operations. So yeah, it totally makes sense. Well, thank you so much, Jeff, for coming on. Please give the listeners a way that they can learn more about you and get in touch with you, and anything else you'd like to share.
Yeah, you can get a hold of me, Jeff at synergetic.ig.com, and I'll spell that synergetic.ig.com. And also, for those of you that are on Clubhouse, I open up a room on Clubhouse on Tuesdays and Thursdays, 4 o'clock Pacific, if anybody wants to join in and have a chat.
Awesome. Well, I hope you check out Jeff's stuff. Thank you so much again, Jeff, for coming on and sharing about your background and experience in real estate. Really appreciate it. And to everyone else, we'll see you next time.
Thank you very much.